All right. It's another week, which means it's another Ask Me Anything happy hour. And we are live with everybody here waiting and patiently eager. No, we're not patiently eager. We're just eager to answer your questions. So we will be right back with some answers to the questions you have not given us yet, but that you are thinking of while you're baking your turkeys, cooking your turkeys, getting your faux turkeys ready, and the mashed potatoes, and save me some stuffing. We're right back. All right.
We had a shotgun pump. We're ready to go. Let's rock and roll.
We are back, and I'm trying to figure out what is going on because it doesn't look like we're streaming on all of our channels again. I just don't know how to fix this whole tech issue, but the show must go on. So let's dive in. What questions do we have? But before we go to questions, let's go around the happy faux turkey little gang here. Steven, what's happening on your end?
All right, just ready for Thanksgiving and eating some food and hopefully not getting fat in the process. And what else? What else we got going on?
Car bombings.
Looks like there was a little attack on the Canadian border up north of Chris in Niagara Falls, so kind of keeping an eye on that. There was a car bomb explosion occurred, and looks like there could possibly be another one, and who knows? It's a wild, wild world right now, that's for sure. But no, just thankful to be here. Thankful for all of you for being here, for this team, and super excited for everything we're working on right now and coming to you soon in 2024. So I'll just say it now, be ready. In the meantime, if you want to get educated, we got a really cool Black Friday special going on right now. Over 90% off of some of our best-selling stuff. And so I'll put the link in the chat box, but pick it up for yourself, for a friend, for a family member. You can't go wrong. It's a great gift to give somebody during the holidays, the gift of financial education and control.
Well done, Steve.
I'm up here with Chris trying to duck the car bombings and stay out of harm's way. And answering questions as we go. Getting ready for tomorrow, and fat guys like to eat, so don't put your fingers too close to my mouth.
Eat to live.
Don't try to steal his food, folks. Don't try to steal his
drinking.
food.
I'm not usually drink on Wednesday. I feel like this is happy hour though. It's the day before Thanksgiving. Like, you should have a drink, right?
I got one.
You should. I ran out of beer.
Well, I know who you guys are, so I'm gonna skip the intros. I'll be right back.
All right, Hannah.
Well, hey, y'all. I'm calling from Dallas, Texas today. So we're over here at my grandparents' house hanging out. Later on today, I got to go pick up Piper. Piper's at doggy daycare. She had her spa day today. So she's going to come back all clean and all trimmed up. But I don't know. I'm just I'm thankful. I'm very thankful for this week and just everybody being here. And thanks, y'all. Thanks for choosing us, because you guys could go to any other infinite banking practitioner and you choose to be a part of our family. So I appreciate all of you being on. So Jason, what's up?
I love that. Hannah from DFW area. That's cool. I did not know that you were originally from there. I always thought you were a Kansas City person, so that's super cool. Life's good, man. I'm super grateful to be here as well. I got my dad's here and his friend Debbie's here. We got the cold plunge hooked up today, so by tomorrow, that's what we're doing on Thanksgiving. We're all the Sipples are jumping into a 39-degree cold plunge to regenerate, to grow our lives, and just to be grateful to have my family here, and looking forward to spending some time here and answering some questions too. How about over to Craig Yanni? I'm going to do this right. Yes.
Yeah, you got it. Thank you. Yeah. Happy pre-Thanksgiving. And I'm also in a different location today. I'm out in the Gina's horse ranch where her parents and her family raised lots of horses over the years. And I wanted to be out so I could be with the horses and show everyone the horses, but they're hiding as far away as they possibly can because we just came back from some target shooting. So no horses today, but yeah, absolutely appreciate you guys all being here today. And There's some of Gina's ribbons in the background from all of her
Uh-huh.
winnings in the
Wow.
past. But yeah, they actually have some Triple Crown winners from the past. But I don't know all the horse lingo, but some big stuff happened out here.
I'm just trying to see if Steven can master the head on his Guinness here.
He's going to do it.
It's pretty good. I love the sound. You ever heard that crack and then that pour? Look at that. Come on, show the camera. Is it gonna froth over?
Don't spill it.
Good. That's good.
Well, Dolphins going to win the AFC this year, baby. Let's go.
Now we learned in Ireland you are not allowed to take your first sip. No, not yet. You gotta wait. Yeah, you gotta wait. Very important. It's Irish tradition. You do not drink that yet. You gotta let it all come. All right. Anyway, let's get into some of the questions. Who wants to handle questions, or do you guys want me to? Because it looks like there's a lot of them. We can start with Anna's. So Anna said, from call to application, how long does it take? Hannah, that's a great one for you. You probably know the exact numbers.
Yeah. So it takes about 4 to 6 weeks to get approved. But honestly, however fast that you can get through the process, sign that application, get it submitted to the insurance company, get in contact with your application specialist, reply to them when they're asking you questions, get that exam scheduled. I mean, I've been seeing approvals anywhere from 2.5 weeks or so. So I normally say about 4 to 6 weeks from the time that you start that application, from the time that you're funding that policy.
Awesome.
I would say, I'm going to add to that and say a lot of it, because I share this every day. A lot of it's really based in you folks. How fast do you want to go? There are some hiccups that we can't control. There's some HIPAA things, requesting physician statements, stuff like that. But if you want to go fast, if you know what your goal is and you really want to start banking, get out of the market, get your money where it's going to be safe, secured, and growing, it can be fast. I went from start to funding in 14 days. My wife with the paramedical, meaning someone came to our house, took her blood, urine, height, weight, went from start to funding in 18 days. So if you get the documents, sign them, move it forward, everything's adjustable. A lot of people would freak out and they're like, wait a minute, is this really what I need? Is this the best, is the most optimal? Well, we designed it based on a really good conversation with you, based on your goals, short-term, long-term. So right at the moment, it is the most optimal, keep you moving to get you approved because it's a trial. And once you're approved, then we can adjust things if needed. But you just got to sign and move. So 4 to 6 weeks, longer. Our average is longer than that, but it can go a lot faster.
Awesome.
Oh my God, that was good.
Yeah, those are good.
First sip of alcohol I've had in at least 20 hours.
20 hours, man. You waited a long time. Whew.
Hey, Noggle, I do have one question that I got submitted to me. Can I read that one?
Yeah.
Okay. They are a 58-year-old and they're new to this concept. They are 2 months away from being discharged from a Chapter 13, or excuse me, he's past 2 months. So 2 months ago, he got discharged from a Chapter 13 bankruptcy, which he paid 100% on. I am a diabetic, but my numbers are under control. I'm also overweight, but I'm working on it. Now, here's the good news. My wife and I have great income from our jobs, about $300,000 a year. His house is worth $400,000 and he owes $200,000 on it. And after the 13 is discharged, we will have a great disposable income, $2,000 before mortgage. Our savings is tied up in 401ks at our current jobs. What can we do? And now I know this is a lot of information. I did put this over in our chats over here. But what they're saying is that they got discharged from Chapter 13. They got $300,000 a year as income. They owe $200,000 on the house. And after this discharge, they have another disposable $2,000 a month before their mortgage. And they're putting money into a 401k. What would be some of the advice that we would give them if they wanted to start getting into this concept?
Well, I mean, Hannah, I guess I'll ask you this question. What's the rules on discharge from Chapter 13? Like, how long after do we need to wait on that?
Yeah. Some companies, if it's fully discharged, they will consider you. Some companies, they do have you wait at least 2 years.
Cool. So we're talking about the ones that we can do it with. I would say, like, a couple questions. They got great income, good disposable income. The house is 200,000. So we could always look at that. But I think some of the other things is really just looking at repositioning some of the assets that they're saving now, looking at how much they've got going into their 401k. Is it above the match, and why? Should that be redirected to solve some better, easier problems that are happening today, not however long retirement is away? So those would just be some quick observations. It's definitely a lot to unpack there, but we can get them approved. They already have disposable income. They have great, income as a household, and I don't know if the house would be the thing to pay off.
Yeah, I agree. And that's kind of why, actually, Joe, I wanted to ask you this question, because a lot of people, they want to pay off their mortgage, right? Because it may be their biggest expense or whatnot. And maybe they just want to live debt free. And so sometimes, though, it may not be the best cash flow situation to go and just totally pay off the mortgage. Because, Joe, how many mortgages do you maybe have right now on different properties, or even HELOC loans that you got out there? You got a lot?
I'm at 3 right now.
3. And because what you're doing is you're not going out there and paying off the mortgages right now, because you are using cash from your policies, cash that you're making from your investments and active income. And then you're using that money to go put out towards more investments, because who cares if the banker is going to charge me a 2.5% interest rate when I can go over here and make that money work for me over in private lending, doing forklifts or semi trucks is what Joe likes to do. So it's just a big cash flow game. I mean, even myself right now, I am not paying off my mortgage, because who cares to pay off my mortgage? Because I got other opportunities over here that I can go and deploy that capital that's going to create me more income monthly, that's going to be greater than that payment I got to pay to the banker for that monthly mortgage payment. So my advice to this individuals is that, with the 401k stuff, contribute to the match if you want to, but I wouldn't do anything over the match. And then I would just pivot where you're saving and keeping that leftover keepings money on a monthly basis, and then start building the capital over there. So then take that capital, and how can I really now use this for wealth building, putting this money to work and working for me.
Love it.
Amazing. Would you guys too, like, one thing I know, none of us are financial advisors, so disclosure, Gabby's not here, but I'll do it for us. No financial advisors. Labatt's Blue. Holy cow, I haven't had one of those since I was in Rochester. Yeah, that's awful.
Terrible. The only thing was in the fridge. Joe didn't drink it last time I was here. If somebody would just, next time they come here, bring some good beer.
So I had 2 thoughts for these folks, right? One, great job. Keep working on your health. That's going to make everything more efficient. Keep working on your A1C. Make sure it's, down below 7. A1C is below 7. And then with the 401ks that you both have, how are they doing? Like, how are you feeling about them? Do you have any loans out against them? Is there an opportunity there to take out a loan up to a max of maybe $50,000 and you have 5 years to pay it back into the same system? Does that make more sense? You have a lot of variables. So like Chris identified, find the leakage, right? Find the financial leakage. Like Hannah's saying, what is the money really doing in this moment? Like if I have $288,000 in cash value, like for a mortgage I could pay off, but I'm only paying $1,600 on a mortgage, I can go out and make almost $3,000 on that $288,000 lent out at like 12%. Mm-hmm. So you got to ask yourself, what is the money doing in that situation? And you might have some more lazy money laying around in the 401k that you can explore. So.
Yeah.
And that's why you just got to hop on the phone with us and we'll go through your specifics in your scenario.
We got this one from Terry. Hannah, do you have t-shirts? Do your dollars make sense?
I'm getting Maddie on that right now. Hold on. I want to tell you something else that somebody told me today. Hold on. Because I wrote it down. All right. And I'm about to use foul language. Okay. So just FYI, any children listening.
Chris has got a swear jar. You can just put your money in his swear jar.
Yeah,
she said,
it's full. It's full. I need a bigger jar.
She says, I'm ready to make my money my bitch. And I said, what if I put that on a t-shirt?
There are some people that would wear that t-shirt.
Are you wearing a hockey jersey?
Yeah.
Are you in Buffalo too?
No, Dallas. What do you mean? I'm not getting it.
It's like a Canadian thing.
There you go, Joe. So Anna wants you to get a hold of her. She's got a lot of comments. I don't know if you've been reading her comments. All right, let's see.
We can do that. Text me.
Quick. We're doing initial dump in, need delay thing. Here, I got to put it down here to read it. Super quick. Do an initial dump in, need to delay signing about 2 weeks. Did something come up? Process was quick. Oh, so Chris George is just kind of feeding into the chats.
Thank you, Chris. Glad you're here. Thankful for you. Grateful for you. So that's one of a few for that man. He's going to jump in and learn this.
We got Jimmy Davison on here. Chapter 13 shows up on your credit report for 7 years. It will definitely affect rating. What do you think, Hannah? Do you think that could affect rating? I would assume probably. Maybe not much.
I don't think it will affect the rating. I mean, if anything, they just want to make sure that you're not going to get into another financial bind where you got to file another bankruptcy, and they want to make sure that you're not running from the IRS, because if you're not, the insurance company will come back and say, "Hey, why are you purchasing this policy and not paying the government?" But I mean, as long as it's discharged past that 2 years for some companies, that they'll consider you again.
I think once they have the parameters in place, right, it's all about risk. So do they see a turnaround? Like, everyone deserves a second chance, right? There's a lot of people we help with bankruptcies. So it's just a matter of when and what does it look like now? Like Hannah's saying, is there a risk now? The insurance company is looking for risk. That's why they look at your health, your behavior, your financial. They're saying, hey, are you a good partner? You're going to be an owner in our damn company. Do we want you? Right? So
hopefully they don't watch the show. I'm gonna get the
so we got Tracy Neighbors coming in saying, how much is the minimum to put in, and does all my loans qualify me without a lot of out-of-pocket money?
Who wants this one?
Loans qualify me without a lot of out-of-pocket money. I'm not quite understanding the way it's worded. Anyone want to take a stab at that, or should we ask Tracy to reword that? Because the minimum is easy, but then does all my loans qualify me without a lot of out-of-pocket money? Don't understand that. Does anyone understand what I'm not?
No, I do not know. Same thing. Love some clarity on that, and that would help us give you some more.
Let's see. Tracy right down here has a second part. Let's see if she hits what we need there. Plus, I got high credit score. How much does it matter? So, Tracy, if you could, the first question, if you could, I think we understand it. Maybe just put those two together in one question, just a little bit easier for us to articulate what you're referring to in regards to loans. So, like, what loans, Joe?
I think she's kind of thinking about it as a mortgage, credit score. I have bills. I have debts.
Kind of what it sounds like.
Right? For this kind of thing.
Let's let Tracy re-ask the question, and then we'll come back to it, because otherwise we might be answering a question that we just really don't understand. 2 to 4 years after discharge, drops credit score. So we're just kind of feeding in some of the comments. Drops credit report, maximum of 200 points. Insurance companies use credit report to rate us.
Soft pull.
So yeah, it's a soft pull. Let's see. So let's see. What does Lucy got here? So there's a lot of things. I'm just trying to scroll down. This, and just so everybody knows, I suck at the question thing. It's usually Gabby's role. So I'm just filling in today and doing an awful job at it.
No, you're doing great, man. You're doing great. Usually Shauna, Gabby, Hannah, even they do a good job reading questions. Okay. Your reading skills are getting pretty good, though.
Well, the things, a lot of them are just comments, not questions. So I'm trying to decipher comments and questions. And if anyone sees a question, just let me know or pop it up there.
Yeah, I've got a question I can post here. Here's a question. So this was sent to us, emailed to us the proper way that you can do it before the show. So it said, if my loans come out of the insurance company's account and not mine, what is the benefit to paying them back? That's part one. So let's tackle that one, and I'll go on to there's the 3-part question here.
Well, that one would have been easy. You should have joined us for the wealth webinar today. We literally mathematically articulated the power and the reasons why you should always repay your loans. And it's not because the insurance company gives a crap. It's because it mathematically makes you more money. And if you're doing the infinite banking concept to make more money, then it always, always makes more sense to be an honest banker and pay your policy back. I mean, literally, it's such a drastic difference. You know, and the other thing, too, I always can't understand. People are like, well, why would I pay myself back? It was my money. Okay, Great. You pay off a credit card, you pay off a car loan, you no longer owe that money. Awesome. Congratulations. Like, happy for you. Where's that difference going to go that you used to give the car companies or car finance companies or the credit cards? Where's that money going to go? Someone else's bank. 100% of the time, when you no longer have a debt or you have new money that comes in, it always goes to your traditional bank. And if you just pay attention, like, your traditional bank makes your money go out and work for them. Why not change that and have your money work for you, not them? So it's always a hard thing for me to articulate. And this is, Hannah, this is the backward bicycle story. We always talk about it. Like, you got to learn how to ride the backward bicycle. And I feel like I'm so far into riding the backward bicycle that I can't even understand how to ride the regular bicycle, which is where this question comes in. Because if you got this extra money that you no longer owe to somebody else's bank, and it's going to sit in somebody else's bank, why would you have a problem putting it back into your policy? Because then you're paying the loan down. Every payment you make back to the policy as a loan repayment is money you have to use the next day when the check clears. But yet you're paying down the loan, meaning you're paying the insurance company less in interest while all your money earns all the interest compounding. Anyway, I maybe that's not the right way to articulate it.
No, I like to reframe it this way. I like to say that, hey, it is, when, just think of it this way. You're an owner in one of these mutually owned companies, right? These mutually owned, dividend paying, A+ rated or better. So you've gotten into the club of being a banker. And now you're taking a policy loan against your money. You're borrowing against your money from the generous account of the life insurance company. When you pay them back, it's increasing their profitability, which does what? When it comes to dividends and things, it gives you tailwind to increase your profitability. I like to think of it as like an everyone thrives community. Like, you're working with people that want to work with you. They've approved you. And now you're helping them do better, and they're helping you do better. I think that's an easy way to think about it too. And Craig, you were going to jump in over here.
Yeah. And, one of the things we talk about all the time is can you earn money at 4% while you're borrowing at 6%? If you haven't been through that exercise, if you haven't seen that in our videos, that's also a critical component of this, because people don't understand that you can grow at 4% while taking a loan at 6% and make money all day long.
And Craig, do you have a good time? Because this is something I say that, hey, it took me, I'm not joking, 19 times playing around with the two time value money calculators and going and looking like what that was. Like, you can go all the way from 3 to 6. Like, you can, borrow at 6 and earn at 3, compounding, and actually still make a little bit of spread. Not a lot, but you're pretty close to even. So do you have a good calculator that folks can go and play around with other than just watching our videos? Because people like to do stuff, right?
Yeah, I think there's any calculator on the internet. Just go to a compound interest calculator, plug in, say, 25,000 for 5 years at 4%, 3%, whatever you want to use. And then go to a loan calculator and plug in 25,000 at 6% and just see what's the balance of the growth at the end of 5 years versus the amount you spent over 5 years. And you'll see what we're talking about, where at $25,000 at 4%, I think you'll make about $30,500 and some change. If you take a loan at 6%, you'll pay about $29,000. So we're still making about $1,500 by borrowing money at 6 and growing at 4.
And the longer you spread out the time, the more money you make. So that's another thing you'll see. Here's the second part of that question, y'all. So
wait, Jason, before we move on,
okay.
I just want to tell the community, actually, I have a podcast episode coming out soon on this. I got my YouTube channels and all podcast platforms, but I do it live. I actually go in there live and I do the differences between earning 10% and paying 20%. You still come out on top when you are earning 10 and paying 20. So we got to learn how money really works.
Maybe like Hannah someday, like Hannah and Chris. Look, practicing my pointing. You ready for second question? Second part of it?
What was the question?
You just keep on drinking that Guinness, man. You're doing good.
I'm so confused right now.
Is it possible for the entire death benefit to be spent by loans, interest, and fees?
Where are we?
These are questions that were submitted to Jason off, like.
Yeah, to Gabby, to the Ask Me Anything thing that she sent over. I put it in our group chat.
Okay.
I just don't know how to post it.
Can you read that one again?
Is it possible for the entire death benefit to be spent by loans, interest, and fees?
No.
No. Because now and here's the thing that people have to be responsible about and take their ownership. You got to pay the premiums as long as you pay the minimum base premium, and as long as you pay that annual simple interest on your policy loans, you'll be fine. And those are just the commitments that you got to make to yourself. But no, you can't. The only person who can implode in this policy is you and how you use it. And who do you know better than you, right? So as long as you know you can make that minimum base premium and that simple annual interest on the loans that you're taking out, you're fine. You're gonna be kicking and thriving in this stuff.
Yep, and I would echo the point of pay your loan interest at a minimum. That's what you want to do. You don't want that compounding on you. So you may not pay it year 1 or year 2, just depends on your situation, but we're going to go back and pay that again at some point. So long term, we're not going to let that compounding get away from us.
Yeah,
time for a new wife on that one, huh?
I've been like trying to get that one up on there the whole time. Like, try to get my what.
You know what Dad says? Let me get this one, because Dad does it with a little bit more passion. But he says, hey, this is about your financial future and your financial health. I bet that you spend the time at the end of the night spending an hour, 2 hours watching The Voice, The Bachelor, or any other show out there. So why do you not make it a priority to you really learn about your financial health? Because this is going to carry on for your entire life. You got to start making the time, and you got to start making those priorities. You know where somebody's priorities are if you look at their checkbook and you look at their calendar. And if they're not making the priorities to do this, nothing's going to change, and you're going to be stagnant for the rest of your life. So no, you can find the time, and you got to find the time. And if not, then this stuff ain't for you, and you're just going to be a slave to the banks your entire life. Sorry, that was very bold statement.
Yeah, I don't know if he wants to say that. I mean, because then, it is the holidays.
I know.
I think all the advice you guys gave this poor gentleman about how to handle his wife will land him in the doghouse. He will get no turkey, no stuffing, no mashed potatoes. You guys are failing this guy for his question.
Hey, you can come over. We got enough for you.
I don't know.
The simplest way to answer the question to your wife is, like, hit her right where it counts. Like, does she have a car? Say, hey, honey, that car, like, we can't afford that anymore. We have to sell your car and buy a cheaper car unless we find a way to get all the money back. Oh, and by the way, this video shows you how to do that. Or, honey, your credit card bills are a bit high. Like, let me show you a way where we can be completely out of debt. Like, I just watched this video, and I think you should watch it too. That'll show you exactly how to eliminate all the debt. And we don't have to work any harder, longer, or save any additional money than we are now. Like, I think you should watch this. So I don't know what her pressure point is, if you will, but you got to find it, and you got to then just solve the problem for her. You're trying to solve your problem by getting your wife to watch a presentation that moved you, but it's not going to move her. And who is dinging?
Oh, that might be me.
All right.
I'm digging.
Anyway,
it's the guy that I have no clue who he is. The mountain man.
All the text messages coming in.
But anyway, just like, she won't watch the video because you're asking her to watch the video. My wife would be exactly the same, so I can relate. Like, I'm living that life. But the fact that she refused to, I would refuse to pay her credit card. I would refuse to give her money for groceries. I would refuse to give her whatever it is she wants until she's willing to contribute and just give her time and watch the video. There's lots of ways to handle that. But by you asking her, I shouldn't say most wives, but a lot of wives or husbands would just say, nope, I'm not watching it because you're asking me. But if you say, but honey, find out what she wants and just say, hey, if you want this is the video that shows you how to do it. Anyway.
I'm thinking that I thought Chris was going to be more gentle and help you, DD Realty, but man, don't say any of those things during the holidays. Or you guys, you're not going to, maybe say, hey, I know you don't want to watch this 90-minute video, but Chris has a 25-minute video. If you're curious, you want to watch this sometime, check it out. Like, just, maybe leave little hints here and there. maybe find out something that she's really excited about, like, how about these diamond earrings, honey? Or, hey, I've always wanted to go to the Caymans or something like that. Honey, a good way to do that would be if we were to be able to find a way to have more cash flow. Like Chris said, Chris had it right, but I don't know if I'd go in with the energy of hey, I'm not going to pay your credit card.
You don't need to cut her credit card.
I'm going to sell your car. I think it's the holidays. Let's be grateful for.
Show her Ariana's video with Hannah. Listen, if this 10-year-old can understand it, I'm sure you can understand it, or maybe not, and then just leave it down, and then she'll grab it, look at it, and say, and then she'll go on to the 90-minute, and there you go.
Yeah. But no, in all seriousness, though, there's different ways that people grasp information, So is she a visual learner? Does she like reading, watching videos, whatever? And actually, like even Devin Burr, there's stuff on TikTok now. It's like 1.5 minute videos where people are just giving the high overview of how this concept works. Start there. Start with 1.5 minute video.
And Devin is dreamy.
Anyone that was given right now.
Ladies don't mind watching Devin. He's dreamy, so it's a perfect person to suggest.
Dreamy.
All right, Chris George has a question.
Hey, real fast before you get there, Chris, I do have a major story I completely missed on What the F this morning, and it's perfect for Hannah and the team. So we'll share that before we end. Go ahead.
Would you want to share it now? I mean, now everybody's like.
Oh yeah,
you can't do that
with your dreamy lighting. You don't want to share it right now.
You can't just be like, oh, I totally missed this amazing thing. But we'll get to it
after this one. I'll get it ready.
All right, get it ready, and we'll hit Chris George. All right, how does getting policies on your children work? I heard that you can't do one at a time. We have 4 children, and we're looking down the road for setting up family bank with the trust. It's awesome. You're correct. You can't do one at a time. Because the insurance company will look at it and say, wait a second, why are you putting coverage? Why are you putting a death benefit on one child, not the other? Do you not like this child? Is this child accident prone? Like, what's going on here? And I'm being actually kind of serious. But what you should do is really just not so much look at it as 1 or 4 and just come up with a budget. Because with children, depending on how old they are, I mean, a little bit of savings goes a long way. So you set a budget on a monthly or annual basis, however you save. A lot of people save monthly for their children's college and for different things for children. So let's say your budget's $500 a month and you're like, all right, I don't know how to do this. I want to put it all on this child because they're going to school sooner. Just like you said in there, you want to set up your family bank. So it's a family bank. It's a combination of lots of different policies that make up your private family bank. And I think if you just set the budget and you just say, okay, I'm going to allocate X amount across 4 children, look at them as one policy. I know it's 4 policies on 4 children, but really the way you'd look at it from a family banking side is you're really dealing with one pool of money. It's just, there's just a bunch of different insured bodies, which is exactly what you'd want. So I think you're on the right track, but don't look at it as 1 or 4 or 4 is too many and I can't afford to save. Just whatever you're going to put in 1, just split it up amongst 4.
I love that answer. That's a new way to think about it for me, at least.
Really?
I used to always joke around, say you can't have a favorite kid. You got to insure them all pretty equally.
I have a favorite cat, but don't tell the others.
I
only have 1 child, so I can't have a favorite child. I have 1. I mean, it's the only one.
Me too.
Makes it easy, right, Joe?
Absolutely.
Hannah, you were always the favorite child. I know.
That's what my brothers tell me. I'll claim it. I'll claim it.
All right, Stephen, are you ready, or should we do Alexi?
Yeah, no, it was big news. So Snoop Dogg, everybody knows Snoop Dogg. He quit smoking weed. Did you guys see this last week?
Shut the front door. He
gave up smoking. He came out with all these Instagram, hey, I got a bunch of health issues. Like, I'm going to give up smoking. I'm not going to do it anymore. So all last week, he was putting all this stuff out and everybody supporting him and, what's up? And I hope you're okay, and all that stuff. And so then he came out yesterday with this update.
Did you say just joking?
It was the worst week of his life.
This thing's had, am I on the right? This thing's had 50 million views. So here we go.
I have an announcement. I'm giving up smoke. I know what you're thinking. Snoop, smoke is kind of your whole thing, but I'm done with it. Done with the coughing and my clothes smelling all sticky icky, I'm going smokeless. Solo stove fixed fire. They took out the smoke. Clever.
That was it. So he, so anyway, so he made this big, huge deal. He's going to quit smoking and he's done for good and all this. And it was all an advertisement for the Solo stove. That's a smokeless fire pit. So,
Dude, you got to be.
everyone's been coming out over the last 24 hours. He's the most marketing genius of all time and all this. And
Oh
anyway,
my God.
I thought it was funny.
Take notes. Like someday in the future, you know, I got to get much bigger than I am now. I'm going to literally come out with a video like that where I'm going to say, I'm done with IBC. It doesn't work. All of it was all a scam. And then I got to find something to pitch that with, but I love it.
Snoop can make anything cool.
Snoop is
Really?
badass.
He really can.
I mean, he played it for a whole week too. Like he thought people thought he was dying. He had like all this stuff. Played it off for almost a week.
I was like, oh man, my wife was telling a story earlier today how when she came back, her dad had smoked for like 30 years, unfiltered, right? And she came back and she just like, he picked her up from the airport, coming back to Ecuador, and she's like, Dad, you gotta stop. You stink. Your fingers are yellow. Your teeth. I can't deal with them. You're gonna die. And if you go in a home, I'm not gonna take. Like she told this whole really passionate story, and I was right there with Snoop. I was thinking, oh man, he's doing this for his kids, for his family. That's amazing. I was totally bought. Totally in.
You got everybody, man. I mean, celebrities, everybody. Oh, and then last piece of news, just a quick update. Thank you. Christmas came early. The Pittsburgh Steelers fired the offensive coordinator, Matt Canada. Peace out, bro. So now we got a chance again. All right, back to regular.
Wait, are you a Dolphins fan or a Steelers fan? You really can't be both.
I can be both, baby. I can be both.
So you're not really a fan of anything then, is what you're saying.
I'm a Steelers fan, but I support my local team.
Okay.
Holy cow. Wow. I literally, I don't even know where to go. I mean, that Snoop Dogg thing's got me thinking in so many different levels, but let's get Alexi's. Can you explain the difference and or the benefits of increasing versus return of premium? Why choose one over the other? So benefits of increasing versus return of premium. So what Alexi's talking about is there's different options for the death benefit. I'm not so sure she's talking about it from a whole life standpoint. This is very common in universal life. And God, I hate to say the swear word, but IULs. You can pick and choose to have the death benefit increase, or you can have return of premium. So I don't really know how to answer this since this is just not my lane, but I'll let the rest of you take it. And Alexi, if I got that wrong, please correct me later. But in whole life, the only thing that happens is your death benefit increases as long as you're making premium deposits. And then if you ever choose to have your dividend pay your premium, your death benefit will either stay the same or slowly fall because you're using dividends, which used to increase your death benefit to now support your premium deposits, neither of which we ever teach people to do because it'd be silly to ever use your dividend to pay your premium deposit, because at that point where your dividend can support your premium deposit, every dollar you put in is probably making $2. Craig, your oldest whole life policy, just a normal off the shelf whole life that your broke ass brother-in-law sold you. How much money is that making for every dollar you put in?
It's a little over $6.
Wait, say that. I'm sorry. I got some earwax in my ear. What'd you say?
It's a little bit over $6 for every dollar put in. So I'm going to continue paying those premiums. When they're pushing me down the hallway in the hospital, I'm going to be yelling, "Did you pay my premiums?" That's going to happen again in December here.
So just think about that. Like for every dollar he puts into that broke ass brother-in-law sold whole life, nothing like what we designed, he gets $6 back. Puts a buck in, gets $6 back, right? So if Craig is homeless, he's still making his premium payments. Because why? Because he could literally just put a sign out front, "Give me $1, I'll give you $2 back," and Craig makes profit.
Oh, wow. I never thought of that. I think I'm going to do that.
Brilliant. Come on, that's what I get paid the big bucks for. Like, maybe it's the Labatt Blue. I don't know. That's just dog shit beer. But, you know, like, think about that. Like, why would you ever not put $1 in when you get $6 back? You'd have to literally need psychiatric help if you stopped putting money in. But anyway, back to reality. And in IUL, you're probably looking for ways to stop making premiums and get a return of premium as fast as humanly possible because, well, anyway, anyone else want to hit that?
I think we answered that one.
All right, good.
I'm good with it.
I concur.
I'd like to Joe about forklifts. Where do I find his contact info? Do you want to give Brad your contact info?
Sure.
Okay. Oh,
Isn't that Archangelo anyhow? It's not Joe.
We're gonna no, we're that's a new verb now. I'm just gonna Joe.
Joe,
I'm gonna
yeah.
Joe
Yeah.
it.
we're just going to Joe.
We all knew what it
I
meant.
like the
we all,
Joe.
we all
Awesome.
knew what it meant, so we're all
Like the
that's
Joe.
good.
I love
Perfect.
that.
Joseph.
If somebody
Joseph
wants
at
to put
Chris
be,
Naughton.
yeah, beyourownbanker.com is where you can kind of learn more about that. But you could also set up a call with Joe, which might actually not be a bad choice. All
Joseph
right.
at ChrisNaughton.com.
David and Dorothy, what's up? Let's see. How would you handle? Ooh, this is a good one.
Really?
I love this question. Joe, you should be all over this. So OJ said, how would you handle an 8% HELOC I just got? My policy is about to start next week, but I was going to lend on the HELOC outside of the policy for now. Should I start another policy immediately? Boy, oh boy.
If you're gonna lend out of a HELOC at 8% and put it into an investment, obviously more than 8%, you might as well run it through the policy. A, it works as a hedge. B, you make money in your policy. Why? Because you're gaining dividends and interest of 6, borrowing it at 5, making 1 in the policy year 1, plus the spread that you're going to make on whatever you're going to invest outside of that 8%. So even at 12%, you're going to make an extra 1% in year 1 with running it through. And in year 11, you're probably going to be at 200 to 250%, so you can't beat that anyway.
All right. Anyone else want to comment on that?
He's moving around. Like that's what Joe would say. Velocity of money. Get it moving. Chris, how did your thing go with Christy Van? Did she like prove that you could use your mom's HELOC to
100%. So like I have a mortgage on my house, we'll just round up, and this is kind of relevant for this, for $650,000. Okay. My monthly payment on my house is around $3,300 a month, you know, and my rate's, I don't know, 3.75. The problem with mine is mine, and I don't know how I did this, but it was like a 7-year arm. I literally didn't catch this until after I caught it. So shame on me for not reading the contracts. How many of you don't read your mortgage contracts when you sign them? Well, that's what happened to me. So my mom house that has a HELOC on it. So what we're doing is once a quarter, we are taking a $50,000 loan from the HELOC, paying down the mortgage. So let's just say it goes down to $650. Then from my income, and this is where it might be different for some folks, but from my income once a month, I'm basically putting, I think it's like let's say 16,000 a month is going into my HELOC, replenishing the 50 over 3 months. So every 3 months, I'm repeating this cycle. So, you know, month 2, I do another 50, but that 50 got replenished by the 16 and change I put back in, paying this down to 550. So eventually what this will do is pay my entire mortgage off. Okay. The HELOC will completely get paid off. Now I realize like I might be able to do this, but most people maybe couldn't. So it might take you longer to pay your mortgage off, but still, like if you got a 30-year mortgage, most people right now are probably 20 to 28 years left on their mortgage. Wouldn't it be cool if you paid it off in 14, 10, 9? Like I'm paying my mortgage off in 5 years. Actually, it's less than that. I think by doing this, it was like I pay it off in 4 years. It might even be a little less. Joe, do you remember? It was
No, it's about 4.5 years.
Yeah, 4 to 5 years. My mortgage was paid off. Now I think I'm going to increase this because my mom's HELOC has 70,000 right now, when we're trying to get that to be more. So if I can increase this, I will pay this off quicker, and I'll just divert more income up there. You know, I guess I'm fortunate that I have the income to do, but I'm just saying this would work for everybody. You might not be able to do it in 4 or 5 years. It might take you 10, but it's still better. So this is what I'm doing. So Jason,
what are you saving, Chris, in that scenario, just so people understand why you're doing it? Like, what are you saving?
I can't remember the exact number, but something like $400,000, something like that comes to mind. It's so significant that it just is kind of silly to even talk about. It's
You
literally
get
like,
a $400,000 return on this investment for yourself.
but that's looking at my savings was 400,000 before we knew that it was a 7-year ARM. So when we actually looked at the contract, which I did because of looking at this, when my ARM comes due, I think, what was it, 2027 or something like that, or 2025? I think it's 2027. What is my rate going to reset at? Is it going to be 3.75 or is it going to be higher? I don't know, but I'd assume it's going to be higher than that. So my savings probably is more than $400,000. I don't know. It's nutty. And I'm doing nothing different. Like literally, I'm just shuffling money. This 50, it's over here. I mean, it's just working for me. And then this the 16,000 a month. I mean, that's money that probably would just go to an investment. But this is how I shifted. I just shifted the 16,000 a month to go to this.
Well, that's why I was asking the question, because I wanted to know what made you make the decision that you wanted to pay that off, because you learned something new. This is what's cool. Like Chris is teaching something he just learned a couple of weeks ago. Like he wasn't sure that a HELOC could pay this off that fast. I remember we were in AMA talking about it. So like you teaching this right now is super cool because we can all learn something new. There's always going to be another level of learning for all of us. And if we get to that, Chris talked about this in one of his videos. If you end up, thinking you arrived, then that's a problem. That's a problem. You got to keep growing, keep learning, keep finding new ways. And I was just curious, like if you're putting that 16,000 a month, over the course of a year, are you making a bigger return than you would paying your house off? Like what had you make that decision ultimately?
It's just math. I mean, I didn't make the decision. Christy and Joe actually came in and did a secondary solve for me. So like when I did the math, like a lot of people would be like, well, what? That's stupid. You're only saving 3.75. Nonsense. No. I'm saving double this money that I'm doing this with. Number one, I'll have a paid off house. Number two, I won't have to bump into the ARM, which I don't even know if I want to say this. Can we hit pause? Anyway, but like in 7 years, when this thing matures, the bank isn't going to refinance it. There's something the bank doesn't know, but the house isn't owned by me anymore. It's owned. I control the house, but I don't own it anymore. It's owned by a trust, and the bank doesn't know that. Anyway, not important for today.
As long as the payments keep getting paid.
Yeah, that's not important for today. So what is the return I'm getting? It's north of 10%. I can tell you that. How can that be? I'm only 3.75. It's way north of that. It's actually probably way more, because if I pay it off in 4 years, I'm literally skirting around the highest years of velocity that the bank has charged me. Like every payment I'm making on this mortgage, like 80% is going to interest. So she calculated it, and I can't remember, but it was a staggering return. It was like high double digits. So
3.75 is approximately 13 and a quarter ish.
Yeah. So, but that's not looking at paying it off in 4 years. But even if it was, let's just say it was 13.25. How many of you think that's a good guaranteed return on your money?
No, that's it. That's what I was gonna. Well, pointing the wrong way, but that's what I was gonna say. Like a lot of the conversations we have, I'm glad we kept going with this, because a lot of conversations we have, people, what do? They're giving their money, they control their money to somebody else, right? Mm-hmm. And the thing they want to do is they want to say, hey, how can I invest in crypto? I want to be in some Coinbase stuff. I want to be in some real estate. I want to be in this and that. They're in all these different things. They got all these little tiny things, getting them a little bit of return, but they have all this damn debt that's guaranteed debt. Mm-hmm. If they would tackle the debt, like I've shown where I talked to a HVAC guy. He had two $20,000, and I've been talking about this a lot in the webinar, two $20,000 credit cards for his business, $670 a month for each of the things. That's $1,340 a month at $40,000. You lend $50,000 at 12%, it's $500 a month. You're almost getting a 36% return by paying your debt, and it's guaranteed. There's no risk. There's no first lien position. There's no if you ain't first, you're last. It's guaranteed. You're stacking guarantee on the guarantee.
People make this mistake every day. That's why we have 74 people the day before Thanksgiving on Ask Me Anything. People are starting to kind of become aware. It's almost like, red pill or blue pill, right? They're becoming aware that, holy shit, things aren't what they seemed.
Yes.
It's just like the returns people want, the dream returns, the returns your advisor says, well, if we really take a lot of risk, we can get this and we can make this, and the average is 13%. But like, what if you could get this return guaranteed, or the 30% return you just said. Every person pretty much that we meet has the opportunity to do this. Just pay your freaking house off. Like, I feel bad sometimes. We're always beating up on Dave Ramsey when he's telling people to pay their house off, but like, he's right. It's just don't use a fucking envelope. Excuse me. Swear jar. Anyway, don't use an envelope. You know, there's better ways. Like, there's so many better ways.
But don't leave the equity in your house then. Put that to work and make more money.
Well, we didn't get into that. I mean, listen, when the house is paid off, like if it wasn't owned by a trust, I could get a HELOC. I'd have, my house is probably worth 1.1, 1.2. I get a HELOC for 80% of that. Then I just lend that money out to the Fullers or someone else, or I buy forklifts or semi.
800,000 at 12% is $8,000 a month.
There you
Extra.
go. There you go. Ah, if only I owned the house, man. Anyway, Richard Mullins. This is a good one. I'm 40 years old. I have 3 1090 policies, and just for those of you that don't know, that means 10% of his premium deposits are going to base, and then 90% is going to the paid up additions. It's a policy design that gives you really high early cash value, but hurts you in the long run. $25,000 a year on my wife, daughter, 20 years funding. It's 5 years old, so it's in its efficiency point. Is it best to get congruent policies for later years that favor base rather than PUA? So, Richard, it sounds kind of like maybe you watched a few of the videos that we put up on this. So I am not, you know, I'm not a fan of 1090. Have I done 1090s? Yes. I have illustrations over here for 1090s, but they were very unique situations where the client literally needed the most amount of money early and the max amount of flexibility. But for the majority of our clients, I would say for probably better part of 98% of our clients, a 1090 is not the appropriate recommendation because it's so heavily reliant on paid up additions that the policy literally peters itself out and fizzles itself out by about the 10th year, because when it's getting to be the most efficient point, that's when your premium deposit drops, or you got to keep term insurance on. And after that point, the term insurance gets pretty costly as you get older. So definitely, Richard, I would highly suggest, it's kind of just general, knowledge, is ladder your policies. As that's fine that you got those. Like maybe you had a need for super high early cash value, and in the 1090s would have gotten you slightly more than a Slayer, which is a 3565, or a Beast that's a 2575. Maybe you'd get slightly more. However, if you continue that path with 1090s, you will severely hurt yourself in the later years when you really want these policies to work like in your favor and you want to put more money, and you won't be able to. You'll only be able to put 10% in, or you'll have to keep a term rider on, which is literally like lighting a fuse on your policy, because eventually it's not going to blow up, but it's going to get so expensive, you're going to drop the term anyway. My suggestion would be, and I'm sure you're going to hear this from everybody else, would be any policies you do into the future is ladder them, do different designs that are more beneficial for the long term. Something like I'll even go into say like the Steady Eddie Nelson that we always talk about, the 60-40 design. That is a great one. And I have them, Steven has, everybody on here I think has Nelsons, 60% PUA, 40% base. I think Joe even has 50-50 policies, because we've gotten to a point in our knowledge and our use case where we understand how efficient the base is. And we're not playing the short game anymore, because most everybody on this, and a lot of our clients, Richard, you as well, you've already built your base for your banking system. So now you need to really build it for the longevity and in the maximum efficiency in the long run. So I think you're already on that mindset, but I'll let the rest of the team kind of comment on it.
I'm going to jump in. I kind of talked to you about this a couple weeks ago, Chris. A girl says to me, one of my clients, well, how would you build it? I said 50-50. So she did $100,000 dump, $15,000 a year. We built it as a 50-50. In the first year, she leaves in $7,500 and has access to $7,500. What do you think happens in year 2? She puts in $15,000 and takes out $16,000. She already has a money tree and she already made $1,000 in year 2, only because she did a 50-50 in year 1.
And here's what I said. Joe told me this in a drive down to PA. I'm like, I don't believe it, Joe. There's no way it's positive in year 2 on a 50-50. It can't happen. And he pulls the illustration up, and I'm looking at it in total disbelief, being like, you got to be freaking kidding me. So
and on the husband too.
It had so little. I don't even. Did it even have term insurance on it? I can't remember.
I'd have to look it up.
If it had term, it was such a small amount, and because of their age. Now, this isn't the use case for every policy, which is why we designed every policy unique for the client's situation. But for this client, like I literally couldn't even make a case saying, "Oh, you should do this as a beast or a slayer," because the 50/50 was literally so damn efficient. In the later years, I mean, the returns were just stupid.
He asked me in the beginning, he goes, "Why would you do this?"
I did.
I said, look at it.
Do that.
And you said, "Okay, I would go with it."
I couldn't punch a hole in it. I just couldn't.
That's why it depends on every case. We're always learning, right? That's awesome.
So hopefully that helps, Richard. We're going to move on because we are at time, and I want to get a couple more. Speed round. Anna, is the PUA flexible where I can contribute extra money to it so I can take out a loan? Yes. All right. Joe or Drew said no, and I think both are right. So yes.
No, I think Drew is commenting on the loan one that I said. That he immediately put no on that. So.
Oh, okay, got it.
I don't want her to think that we're putting extra term on to make it flexible, though. That she thinks that she can put in 1,000 this month and 2,000 the next month.
All right, we're going to do three more. Melanie said, "Can you open more than one policy? One with qualified funds, one with unqualified." I mean, can, but I wouldn't suggest ever using qualified funds for the policy. It's got to be a very special use case where that would make sense to pay the taxes and the penalties on qualified funds to put it in the policy.
Yeah, they definitely have to leave the qualified world, go into the unqualified world. So
that's an it depends answer. These are probably all it depends, but we're going to do
rapid fires. Alexi, best way to learn about design of policies without having to learn this while going through the process and have time. There's a really good video I did, and Hannah, I don't know if you did one, but it's how to design an IBC policy updated. Do not watch the non-updated one because that was pre-7702. It's old, and I can't take it down because it got like 60-some thousand views. But the new one, how to design an IBC policy updated, will show you exactly how we design these. Let's see, it took me 3 years. I drew. Oh.
That's going back to the gentleman that asked about his wife not willing to watch the video.
Yeah.
Hey, actually, I have a comment there since that question popped up. That comment. In my own family, my mom was not on board with this concept as well. And what really made her allow dad to do this is that because dad was a very big spender. And so she says, okay, instead of him going out there and buying stupid stuff, he's going to be putting his money into this policy. And so she looked at it as that forced savings for himself. So some feedback for your spouse.
Oh, dude, look at this one. Priscilla. The more you make your spouse a part of the dream, the more they will support it because they can see themselves in it. Oh, I don't even know.
It's all a team. This is a teamwork here.
Anything else? That's so freaking.
Yeah, I'm going to share a quick win. I'm the most grateful thing, and I'm like the most gratitude right now in my life is Patty just turned her 2-week notice in last week to join on this journey because of the belief she sees from what has transpired since I've started this journey. Like, so that's it. 'Cause that was the question from the gentleman, the realty guy earlier, right? DD Realty. Like, that's it. Just make her a part of the dream. That was great advice.
Yeah. Then
one day it'll just happen. My wife wouldn't watch the videos. I'm like, watch the 90-minute video. This is what I do for a living. Watch the 90-minute video. No, a year and a half. And now, like, my 9-year-old's talking about his policy. Like, this is how I do. I put money in here. I'm going to buy an iPhone. I'm going to pay it back. He's drawing on the whiteboard last night. I was like, I got to get this on video. This is awesome.
Awesome. All right. So last one.
Or still my opinion. I don't know, but do what you want. Either make a dream or that.
There's always eHarmony. All right. Jimmy Davison, last question. Just paid the premium on my Guardian policy and at the same time paid the interest on the outstanding loan up front. Is this a Guardian thing only? So I just started my first Guardian policy, so I don't have a ton of runway on Guardian, but so if this was was this your very first premium, or this is your second policy's premium deposit and then they charge the loan interest? Because if that was the case, every policy that we do, the insurance company will charge the loan interest when the premium deposit's due. That's just how they do it. They bill interest on the loan one time per year. So that's not a Guardian thing only. That's a every policy thing.
He might be in year 2.
Yeah, I'm not sure. Jimmy, we know you well enough. Just shoot me a text on that, and whether it's 1 or 2, and I can answer that. But
Yeah, year 4, he says.
oh, year 4, yeah.
Oh.
So no, that's a normal thing. Every year when you get your premium deposit, the bill from the insurance company for the premium deposit, they'll always include the loan interest on it. So if you've never gone to a premium deposit with an outstanding loan, you would have never seen that. But if there is an outstanding loan, it's always going to be the interest at the end of the year. Yep. So that's very, very normal. The insurance companies don't charge interest monthly. They just bill it one time per year, which is actually an advantage over the cash value lines of credit that I'm, pretty used to. But with that being said, folks, happy Thanksgiving from all of us here at Money Multiplier and BYOB and Private Money Club. Might as well throw that one in there. We appreciate all of you. We appreciate your support. And it's insane. 73 people. I almost said Christmas Eve. Thanksgiving Eve. We appreciate you. That's all I can say. All right.
Absolutely.
See you next time.
Bye, everyone.
Bye, all.
Bye.